I ended the last post, titled 3.3, with this. Explicating the incentive structures behind financial products and complex crypto schemes is a foresight superpower in a market populated by retail investors and increasingly obfuscated tokenomics. In many ways, this post is an unintended sequel. Now follows a disclaimer. Before I start, please remember that I am actually an idiot. I have zero actual financial markets experience, I'm not a financial advisor, don't understand how money works, and barely understand how the coins work. I was born naked and crying into the cold, sterile hospital light, and not much changed since then. These are just my opinions. They might be bad opinions, and I might change them tomorrow. Anyway, incentives. In crypto, retail investors often seem shocked by the market actors' simple actions. The team sold some tokens. The VC sold their position. The developers did not agree to the proposal to use all of the protocol's revenue to pump the markets and burn the coins, but instead want to invest in hiring and growth. Monsters. Surprisingly little time is spent considering the other market participants' incentives and deducting their likely actions from their potential actions. I started writing this due to the LuxRare drama happening on Twitter this week. If you're out of the loop, LuxRare is an OpenSea competitor with a token that allows holders to share the fees. Some people got upset that the LuxRare team took some wrapped ETH from the LuxRare rewards through Tornado Cash. It was a typical Valentine's Day. I wanted to write a post about how nobody should have been surprised by this. While I'll discuss the LuxRare token's incentives in this post, I'll also run through a few other examples of incentives driving markets that perhaps are not well comprehended by market participants too. Alt L1s. Alternative layer 1s were a popular trade in 2021. Understanding the crypto market's retail participants' incentives in this instance is very simple. They want to make money and participate in the great decentralized casino. Alternative L1s provided two useful vectors for these goals. 1. Very cheap fees. Low barriers to entry for retail investors who can't afford to take several actions on Ethereum. And 2. Being early as a service. Investors see other assets near their valuation potential or having completed significant historic price moves. They want to be early to something, predicting better future returns. To explore all of the incentives at play in these alternative L1s, imagine a fictional alt L1 called Laguna, with a fictional DEX called BubbleSwap. From the point of the retail investors, they want Laguna's price to go up in dollars, and they want to be early to good Laguna-based products and sell them for a profit to increase their overall holdings of Laguna, and thus eventually USD. Laguna chain teams incentives. They want the valuation of their network to go up. Practically, this means they want users and builders on their chain. Eventually, they want to sell off some of their Laguna team tokens to buy a house or a supercar. BubbleSwap founders' incentives. They want to get paid to build something useful and possibly later become rich when they're able to sell some of their Bub team tokens. Thanks to the ecosystems on established chains, users, founders, and investors already know that some products are likely to be valuable. They know that every chain needs a popular AMM DEX, every chain needs a liquid stablecoin and money market, and yeah, maybe every chain needs its own ohm fork, or a dog coin, or something. But they're less likely to be guaranteed hits. Laguna Chain's team are incentivized to fund founders and developers to build a DEX and a stablecoin to make their ecosystem viable for casino goers. They're also incentivized to fund other projects for casino goers to speculate on using that DEX. If Laguna Chain commits hundreds of millions of dollars of their treasury to incentivize products to build on Laguna, they can significantly increase the likelihood of Laguna Chain's longer-term success. Founders see that they can not only get paid by Laguna Chain to build something that, if they execute well, has a high chance of success, but also that they can trivially raise money to build this. VCs are chasing the dragon on returns and they're willing to pretty much fund anything. So, it's just Maker, but an EOS, with the logo of a zombie pineapple. I'm in. As the basics, like a DEX, stablecoin, etc., are established on Laguna and reach their valuation potentials based on comparable market metrics, these chains begin to support increasingly fringe projects in order to perpetuate the casino and sustain users. differently motivated L1 teams begin to reveal their hands. You can see L1's founding team scramble to keep the attention dynamo churning by funding and supporting meritless projects, or you can see them commit to their existing ecosystem and continue building. Pre-sale coins. How is it possible for coins to launch and subsequently only go down in the following 6 weeks? Who are these sellers? Coins launch with the influencer pre-sale into low float IDO often have a similar chart pattern, because the incentive structure is the same in each project. Taking a look at Costa, a token released by popular crypto YouTuber The Moon Carl in January. Costa's all-time high was at the very first day of trading, $1.13 on January 5th, and Costa's all-time low was today, which is February 19th, at 31 cents. To study the incentives of all market participants, we first must understand who the market participants are. From the Costa tokenomics document, we see a pie chart of the Costa token allocation with a lot of different market participants. Looks confusing initially, but we can simplify these into fewer groups. Who are the coins controlled by? Investors, 18%. These are both seed and private. Team/company, 71.5%. These consist of team, advisors, ecosystem referrals, development, marketing, operations, general reserve, and rewards. Then retail traders, 2.5%. TGE, which was an IDO on Bybit, and market makers, 8%. Exchanges and liquidity. Now we know who holds the coins, we should figure out what their cost basis is, their hold length, and when their coins become available. First, when do the coins unlock? The article shows the schedule of all the allocations and when their coins unlock. I'll not go further into this because Cobie explains later on. Again, these vesting schedules seemed quite confusing, but can be simplified pretty easily. Investors, 18% of the supply. Unlocks gradually over 1.5 to 2 years, starting 1 to 2 months after the IDO. Team/company, 71.5% of the supply. Unlocks gradually over 2 to 5 years, averages over 4 years, starting between 1 day and 6 months after the IDO. Specific vesting depends a lot on the tranche. For example, operation coins start unlocking 1 day after the IDO and unlock over 2 years, whereas marketing coins start unlock after 1 month and unlocks over 4 years. Then there's market makers, 8% of the supply available instantly, and retail traders, 2.5% of the supply available instantly. So, in summary, supply starts unlocking pretty quickly, and while some unlocks continue for 5 years, some specific tranches, e.g. investor coins, vest much more quickly over less than 2 years. Finally, what is the cost basis of these holders? Well, the early investors' prices are available in the pre-sale marketing document. The document shows seed investors being able to buy for 1.5 cents and private sales being able to buy for 2.2 cents. Obviously, the team's coins are a cost basis of 0. The market maker coins are also at a cost basis of 0, but they're generally not intended to be sold on the market. The retail buyer cost basis is harder to calculate now with 6 weeks of coins changing hands, but on the first day of trading is likely around $1. So why does the market only go down? On day 1, there was 37 million Costa tokens on the market, with a cost basis of around $1. By 6 months, there will be almost 200 million Costa tokens on the market, with an average cost basis close to 2 cents. Looking a little closer. On day 1, there was only the IDO coins available. Every retail investor that wanted to buy Costa lined up on day 1 to buy into the IDO allocation. They put all their money into that 2.5% supply available in the Bybit IDO. For the first 24 hours, they were the only market participants, since virtually all other coins were locked. But by day 45, there's 2 additional market participants. Investor coins, cost basis around 2 cents, have been unlocking for the last couple of weeks. And the team's operation coins, with a cost basis of $0, have been unlocking for 44 days. The market has introduced new sellers. Investors are sitting on over 50x profits. They're able to sell 2 weeks of unlocked tokens to recoup their entire initial investment. Team operation tokens have been unlocking since day 2. The team previously sold their tokens in investment rounds at 1.5 and 2.2 cents recently, so it seems reasonable that they may also want to sell some tokens at higher prices to secure a longer runway. However, no new buyers have been introduced. Everybody that heard about this product, due to the YouTube promotions and otherwise, was ready to buy on day 1. Anybody that waited to buy probably got spooked by the downwardly price action. In addition, the product still hasn't launched, so there's no natural product-based demand. In fact, the lack of products suggests the rational investors are likely to sell their coins on unlock. The 10k they invested 6 weeks before the market opened is suddenly worth $500,000. They could sell 100k of their Costa, which secures them a 10x in 6 weeks, and still keep 400k invested. If all private investors want to sell 20% of their tokens, the amount of supply they'd like to sell is 2 times larger than the initial allocation available in the IDO. As prices dip, retail buyers might also want to sell and cut their losses, creating more selling pressure. With lower prices, new buyers might start to become interested. Well, it's down 70%, so maybe it's a good buy here. And yet, even today, seed investors are unlocked daily while still sitting on 15 to 20x profits. And the team coins earmarked for various development, operations, and marketing activities are also available to sell. Perhaps the team thinks selling 5 to 10% of their overall remaining equity to secure long-term fundraising through a bear market is a good idea. Hopefully, they can secure that over the counter with a professional fund causing no market impact, but it is within their power to sell it on the open market too. It might even be the right decision long term for the project to temporarily tank the market to ensure they have funds to build through a crypto winter. Still, such an action would not be great for the token price in the short term. And while the team might not intend to do it, the lack of significant cliff in the vesting makes it a possible action. This pattern of token incentives is also the reason that popular crypto influencers and YouTubers often promote coins they invested in, seemingly disclosing their vested interest. But then these coins only seem to go down. Did the YouTuber lose too? Are they a bad investor? Usually, no. They are invested at a significantly lower valuation. The YouTuber invested in a pre-sale and will be at profit even if the market tanks 85%. They are disclosing their financial interest, but not disclosing the asymmetric risk that their audience would be taking. They are invested, but at a much lower valuation that was not attainable for their audience. Meanwhile, the audience has to pile into the low float available at IDO. Looks rare. Another disclaimer from Cobie. Would like to state before I dive in, I do not own Lux, I'm not long nor short Lux on any perps platform. I do not own OpenSea equity. I did not buy the Lux seed round. Some of my friends, like Ledger, Path, and Gainsley, did buy the Lux seed round. Oh, I do not own any Casta or any short Casta exposure either. Anyway, I started writing this post to explain the tokenomics incentive structures that were public in Lux since day 1. I wrote a thread about it on Twitter, but there's no edit button and threads are pretty useless at long form writing. How did the Lux team earn the 10,000 wrapped ETH? LuxRare issues the fees earned on the marketplace to users that have staked their Lux tokens. If the marketplace earns 1,000 ETH, that ETH goes 100% to the stakers of Lux. On first glance, the tokenomics suggest that this reward is 75% community owned, with only 3.3% going to the early seed investors. But not all of these tokens are eligible for staking. For example, the community's staking rewards and trading rewards are earned over several years and thus cannot be staked on day 1. The seed investors' strategic Zil coins are locked, so they cannot sell them, but they are stakeable, so they earn full rewards from day 1. If you were to recreate the infographic above with eligible for staking tokens on day 1, they would look something like this. 70% of the airdrop tokens, 20% of the seed investor tokens, and 10% of liquidity management tokens. The team's tokens also have a staking schedule, making them eligible for staking over time. Then the article proceeds to show the staking unlock schedule. There's additional nuance though. There's a mechanic in LuxRare that prevents the community staking rewards to accrue to the seed investors and the team. This means that the seed stage backers get steadily diluted over time. Initially, they have 20% of the stakeable supply, but as time passes, it trends towards 3.3% over a couple of years. By day 180, hundreds of millions of Lux has been released in volume rewards, and tens of millions of Lux has been released in staking rewards, emitted only to stakers of airdrop and volume reward source tokens, meaning the seed stage buyer's share is significantly smaller as a proportion to the stakeable supply. Finally, you must take into account dormancy. There will be inefficiencies and lack of staking adoption in user-owned coins. Perhaps users don't know about LuxRare, perhaps they didn't claim or stake their coins yet. At the very least, perhaps they are slow to stake the new emissions and don't do so daily. While staking adoption is very high, over 85%, it does mean some stakeable community supply is not participating and thus a higher share of rewards for seed backers and for the team, since there is much less likely to be inefficiency and staking adoption in team-owned and seed-owned coins. So, where did the 10,000 wrapped ETH come from? It's pretty simple. I'm not sure why people were shocked. Maybe Tornado Cash just triggers people. Anyway, the stakeable supply earns the wrapped ETH from fees. The team's share of stakeable supply unlocks gradually. While they're staking, they get a portion of the wrapped ETH from fees. And the fees have been pretty high. On February 1st, 7,230 wrapped ETH was earned in fees by all Lux stakers. The team's share of the stakeable supply at this time was around 12%, meaning from the single day of staking, the team earned 860 ETH. As you can see, with 860 ETH in one day earned from staking, it's pretty easy to see that the team made 10,000 ETH from their minority share of staking over the time since launch. As for Tornado Cash, I'd speculate that the team needs to remain anonymous for regulatory purposes. The more interesting question is, why were users paying 7,230 wrapped ETH in fees in a single day? In addition to staking Lux, to receive Lux staking emissions and wrapped ETH fees, users can also earn Lux by trading using the LuxRare platform. Users earn a share of the daily Lux rewards proportional to their volume. This volume reward acts as a perpetual token sale. Users trade NFTs on the LuxRare platform and spend fees. However, they receive Lux tokens proportionally to their volume or fee spent. Their fees are reimbursed through Lux. Effectively, they're spending wrapped ETH to buy Lux. Every single day, there's a certain amount of Lux available for purchase via volume rewards, where the price is derived by the ongoing daily auctions. Since Lux has a market price, fee-spending wash traders are aiming to pay less in fees than they earn in Lux. If Lux is $2 and the daily volume rewards is 1.5 million Lux, then it's likely that the wrapped ETH rewards for that day will be close to $3 million. It's unlikely to be significantly higher because then the wash traders have spent $4.5 million in wrapped ETH to buy $3 million worth in Lux. It's also unlikely to be significantly lower because the opportunity to buy $3 million in Lux for $1.5 million will be arbed out by the market relatively quickly. Some volume reward earners will be looking to establish long-term Lux positions at the best possible entry, and so slightly below market price is attractive to them. However, some volume reward earners are aiming to earn more Lux plus EV than they spent in wrapped ETH per day, and will thus sell their Lux to wrapped ETH to repeat this process the next day, compounding their wrapped ETH returns. This means a portion of the volume rewards will be daily selling pressure, causing a reduced price of Lux, thus reducing the daily available dollar rewards, thus reducing the amount of wrapped ETH spent on fees and returned to stakers, thus reducing the APY from staking and therefore creating the negative flywheel that we've seen tank the price from $7 to $1.50. Jesus Christ. This may also be impacted as the volume rewards reduce as per the Lux schedule, causing the wash trading to also reducing the overall wrapped ETH fee staking reward. The main difference in this perpetual token sale from a traditional ICO is that the returns of the token sale are returned to Lux stakers rather than solely to the team. Of course, the team are participating in staking, 10% of the stake supply, but 65 to 70% of the stakers are community members staking that received coins from the airdrop or from volume rewards. I'm not sure if this model is good or bad, but it's certainly a novel attempt to distribute a community-owned token and build a marketplace with fees returned to all stakeholders, rather than disappearing into the OpenSea void. When projects distribute their equity or ownership, they should aim to be buying something valuable in return. With their aggressive Lux for fees emission, LuxRare token holders are buying fees, which is wrapped ETH, and attention. I'd actually prefer more of the wrapped ETH to go to the team for war chest building and personally think there's stickier forms of user engagement, but since attention is the scarcest resource in crypto, it's likely still an effective investment if the team and stakeholders are able to translate this attention into real, engaged, and retained users. In some ways, LuxRare has been a victim of its own success. The high market price and valuation of Lux commanded high dollar amount daily Lux emissions, in turn generating lots of wrapped ETH rewards and a bit of a Ponzi-nomics flywheel. As the circulating supply distributes and fake volume incentives reduce, LuxRare becomes an interesting community-owned alternative to OpenSea if it's able to sustain real volume. Fees are already distributing mostly to the community, and their share will only increase over time too. They could have probably made the seed stage share of staking rewards a little clearer, and perhaps figured out some way to reduce the buy to dump volume flywheel. Volume rewards return locked coins perhaps, but then they wouldn't have a war chest to build with, and, well, would we be talking about LuxRare today? The article ends with yet another disclaimer. Please let me know if I fucked up any of the calculations or whatever. I, as always, am not bothering to proofread this post. Thank you for being my crowdsourced editors.